from this one, what I see is that the biggest move in precious metals is yet to come. It's just started. Now, again, this is a logarithmic graph, and so percent change. And if you think the rise from the year 2000 to 2011 was breathtaking, then you haven't seen anything yet.
The central bankers, they know what's coming, and that's why they keep on adding loads of physical gold to their holdings. We saw that China added another 2 metric tons, which is, of course, for official consumption. They're adding a lot more than just 2 tons a month, that's for sure.
Mike Maloney, a leading precious metals expert, argues that recent gains in gold, silver, and platinum represent just the start of a much larger rally. Despite impressive year-to-date returns, he believes the most significant move in precious metals is yet to come. Using logarithmic charts, Maloney demonstrates that significant percentage gains can appear smaller visually than they actually are. He warns that if the 2000 to 2011 gold rally seemed dramatic, the next surge could be even more spectacular. The fundamentals for precious metals have strengthened significantly, with gold, silver, and platinum delivering substantial year-to-date gains. This momentum is fueled by market volatility, global de-dollarization, and growing concerns about the U.S. deficit. ETF experts note that institutional investors are driving the trend, indicating further upside potential if retail investors increase their exposure to ETFs. Central to Maloney's thesis is his assertion that those expecting a monetary reset should reconsider the notion that gold is overvalued. Instead, he argues that it's the US dollar that remains severely overvalued relative to both precious metals and other global currencies. According to Maloney, this overvaluation creates the conditions for a significant correction that would favor hard assets, such as gold and silver. Supporting this view, recent analysis of 26 currencies shows the US dollar is overvalued against 20 major trading partners, particularly Japan, China, and the Eurozone. This imbalance signals a likely rebalancing ahead, potentially driving further demand for precious metals as investors seek value beyond the dollar. Before we begin, don't forget to like and share this video with friends and fellow investors. Subscribe and hit the notification bell to stay updated. Your support keeps this community growing.
You know, if you look after August 15th, 1971, when the first big peak there, and then it drops down and we get let me see what was happening. That was the gold rising, and then gold fell and created, so we're looking at gold basically upside down here. So gold was going up in price, causing the line to fall, and then gold peaked in the last day of 74, and then from first day of 1975 until I believe August of 76, gold fell by half. It had gotten up to $200 and it fell down to 103 in August or September of 1976. And so that causes that peak. Then it went all the way down to the bottom of that trough, January 1980, and then it goes up again, and it's not gold going up, this is gold falling. And then gold does a dead cat bounce and rises again and then falls, and you have an inverse head and shoulders pattern. And if you drew a neckline, which is a trend line, a neckline across those two peaks, you flip it upside down and it's predicting a move going rising, and it way exceeded that. Now, that was predicting that gold would fall and the dollar would rise. Now, take a look at what we've got going on today. We have another slanted, not inverse, but a normal right side up head and shoulders pattern, and we've just broken the neckline. That trend line that you're drawing isn't just a trend line, it's a neckline on a tilted head and shoulders, which is predicting that this is once again a linear graph. And so if this was logarithmic, what it would be predicting probably is a return to the balance, the type of balance that we had back before 1960. What would be the average before 1960? About 7, 8, 6?
Yeah, 7-ish.
Right. Do you see that? There's a right side up head and shoulders in this chart. Yeah, exactly. And so there's a lot of different ways of looking at this from a technical perspective. You can say, yes, it's broken a trend line. And that would mean that either it's overvalued and you should get out of gold, or you should accumulate as much much as possible because it's going to make this enormous move coming up right away because it just broke this head and shoulders. From this one, what I see is that the biggest move in precious metals is yet to come. It's just started. Now, again, this is a logarithmic graph. And so percent change. And if you think the rise from the year 2000 to 2011 was breathtaking, then you haven't seen anything yet. The rise that we've had over the past year and a half is just the beginning of something absolutely enormous. And so if you do think that there's the possibility of a monetary reset, you may want to be rethinking, is gold overvalued or not? The only conclusion I come up with is no. It's still the dollar that's overvalued. And do you think that there's a possibility that we could go into a recession right now? If you do, then they are going to be, if the Fed senses anything wrong in the economy, they've shown their hand. There's only two things that they can do: light up the printing presses and drop interest rates to zero to influence the banks to light up their printing presses. Actually, they're, I don't know what you would call a number duplicating machine. It's just a computer. You're typing in numbers. Bank credit.
Mario Innecco believes central bankers possess insider knowledge of impending monetary changes, evidenced by their continued aggressive accumulation of physical gold reserves. According to Mario Innecco, these financial institutions understand what's coming and are positioning themselves accordingly through substantial purchases of precious metals. China's actions, in particular, illustrate this trend. While the country officially reported adding just 2 metric tons of gold in a recent month, Maloney suggests this figure represents only a fraction of China's actual accumulation. The discrepancy between reported and actual purchases indicates that major economies may be stockpiling gold far more aggressively than public data suggests. The People's Bank of China has consistently demonstrated its commitment to the gold acquisition strategy. The central bank has purchased gold for 7 consecutive months through May, with this buying streak beginning in November 2024 and continuing uninterrupted through June 2025. This sustained 8-month purchasing campaign represents more than just routine reserve diversification. During this extended period, the PBOC has officially added a total of 520,000 ounces to its reserves, equivalent to approximately 16.17 metric tons. This accumulation represents an investment of roughly $1.2 billion at average acquisition prices, demonstrating China's commitment to building substantial gold holdings regardless of price fluctuations. Let's get back to the video.
The central bankers, they know what's coming, and that's why they keep on adding loads of physical gold to their holdings. We saw that China added another 2 metric tons, which is of course for official consumption. They're adding a lot more than just 2 tons a month, that's for sure. And that's not me saying this. It's Jan Neuenhaus, who's done a lot of research onto this topic. I'm gonna try to find one of his articles and put it in the link. He's looked at customs data from China and London to prove that China is actually accumulating a lot more gold. They're supposed to have now 2,299 metric tons, but I would add a 0 to that. Gold has come off quite a bit, but silver has held on really well. And that's why I'm telling you, hold on for dear life to your physical gold and silver. Hold on to your miners, because that's going to be the place to be. And as for gold and silver again, I mean, until you can buy gold and silver with fiat currency, I think it's a no-brainer. That's my opinion. It's a no-brainer if you have spare fiat currency savings. And that's why people have always asked me since I started this channel, where can we get gold? And you can get gold anywhere. You just have to search for dealers. But back to John Exter. So yeah, this was published in the American Institute for Economic Research, Great Barrington, Massachusetts, June 1972. So let's go through this. I think it's really important to go through this because this is a man who was a gold bug as well, even though he was a central banker. So he says currencies today, that is 1972, are IOU nothings. And that's because he said that because Nixon suspended the convertibility of the currency into gold, the currency being the Federal Reserve dollar, right? right? It wasn't a United States Treasury dollar, unfortunately. Commodities like gold and silver, which are being used as store of value money, are not being used as either means of payment or standard of value money. Well, I think that's going to change. We're seeing the central banks go back to the store of value money in a big way, right? By adding to their reserves, and you should too, in my opinion. I'm trying to do it too. Thus, the world we have so long known, in which most currencies were redeemable at a fixed price in the store of value money like gold, is in disarray, and I would argue it still is. 53 years later, people are confused and wondering what money they can trust, sensing the instability of the system as a whole. They turn day by day from one means of payment money to another in the foreign exchange markets, and much more gradually to store of value money like gold in the London and Zurich gold markets. Well, London and Zurich gold markets, because back in 72, it was illegal to buy gold in the US. Actually, John Exter got away with it by buying gold sovereigns. They were considered numismatic in the US, so there's always a way around things. Until March 1968, when the two-tier gold system was established, the central banks issuing all major currencies were promising all holders IOU gold at $35 an ounce. Under the two-tier system, however, the IOU gold promise was abrogated for private people, and except for the South African Reserve Bank, central banks refused to sell any gold at any price. Private people, the IOU gold at $35 an ounce promise was honored only among central banks and governments.
The bullish outlook for gold extends beyond general market sentiment, encompassing specific price projections. Goldman Sachs Research has issued an aggressive forecast, predicting gold will reach $3,700 per troy ounce by the end of 2025. This target is driven by expectations that central banks will continue their significant monthly purchases, adding hundreds of tons to global reserves. Gold continues to prove itself as a reliable store of value amid ongoing global financial uncertainty. With institutional demand rising, central banks steadily accumulating, and long-term pressure mounting on the US dollar, gold remains well-positioned for further upside. As technical patterns align with strong macroeconomic fundamentals, the next significant move in gold may just be getting underway. Is gold preparing for its next major breakout as global uncertainty builds and economic risks intensify? Share your thoughts in the comments. If you found this video valuable, don't forget to like, share, and subscribe. Your support helps us continue bringing timely market insights to you and the entire community. Thank you for tuning in.